In April 2026, BYD did something that would have seemed impossible just a few years ago. According to Motor1.com Brazil, BYD outsold the G4 group of traditional automakers in Brazil, with sales growing 20% in a single month. That's not a regional curiosity. It's a signal about a structural shift in one of the world's most important industries. The global electric vehicle market is reshaping the competitive landscape of the automotive in real time. Companies that took a century to build their positions are facing a challenger that did not exist as an EV manufacturer a decade ago. And the financial implications extend far beyond car companies. This video breaks down what BYD's rise means for the global auto market, how it affects the stocks and the CFDs of traditional automakers, and what the EV transition means for oil demand, commodities like lithium and copper, and the broader market. BYD, which stands for Build Your Dream, was founded in 1995 as a battery manufacturer. It entered the automotive market in 2003, and for years it was largely invisible outside China. That changed dramatically when it became the world's largest seller of electric vehicles in 2023, surpassing Tesla on a full-year basis. What makes BYD structurally different from Western EV manufacturers is its vertical integration. BYD manufactures its own battery, its own semiconductors, its own electric motors, and body components. This gives it a cost structure that Western and Japanese automakers cannot yet match. Its Seagull model, aimed at the mass market, sells for under $10,000 in China. The competitive implication is direct. When BYD enters a market, it enters with a price point that forces incumbents to either compress margins or concede market share. In Brazil, where it grew 20% in April 2026, and in other Latin American markets, it's doing exactly that. For market participants, this creates a set of investable themes. Traditional automakers, large exposure to internal combustion engine production, and limited EV competitiveness face structural margin pressure. BYD's growth also has direct commodity implications. Rising EV adoption increases demand for lithium, cobalt, and copper, while slowly eroding the long-term demand trajectory for oil. Every electric vehicle contains approximately 80 kilograms of copper, compared to about 23 kilograms in a conventional vehicle. It contains lithium, cobalt, nickel, and manganese as its battery pack. As EV adoption accelerates, the demand profile for these materials changes structurally. Chile is the world's largest producer of lithium. The Democratic Republic of Congo dominates cobalt. These supply chains are geographically concentrated, they're politically complex, and facing investment shortfalls that could create supply constraints as demand grows. For traders, this creates one of the clearest long-term commodity themes available. Copper, in particular, has attracted significant institutional attention because the demand increase from electrification compounds with the existing demand from grid infrastructure upgrades needed to support EV charging networks. The oil angle is more nuanced. EV adoption is real and accelerating in developed markets, but global oil demand is still growing in emerging markets where conventional vehicle ownership is rising faster than electrification. The IEA's April 2026 short-term energy outlook revised global demand growth downward, but did not project an absolute decline. The transition is real but uneven. Ford's response to the EV challenge, as reported by InfoMoney, is to bet on a lower-cost electric pickup truck developed through what the company calls its Skunk Works division. Nissan, according to Valor Economico, has canceled plans to produce electric vehicles at its U.S. factory, reflecting the cost and demand pressures that even committed EV strategies are facing. These two divergent responses illustrate the genuine uncertainty in the industry. Ford is doubling down with a cheaper product. Nissan is retreating to preserve capital. Neither path is obviously correct. The market is still determining which EV strategies are viable at scale and which are burning capital without a clear path to profitability. For CFD traders, this uncertainty creates volatility and opportunity. Automaker earnings are heavily scrutinized for EV profitability metrics. Any company that shows a credible path to EV profitability can re-rate significantly. Any company that reveals mounting losses or strategic confusion will most likely be sold. The key metrics to track are EV gross margin per vehicle, the rate of decline in battery cost per kilowatt hour, and market share data in key regions including China, Europe, and increasingly Latin America. For traders thinking about the EV theme through CFDs, there are several concrete positioning frameworks depending on the scenario. In a scenario of continued rapid EV adoption, EV-focused companies benefit. Copper and lithium prices are supported. Traditional automakers with limited EV pipelines face continued pressure. Oil demand growth moderates. In a scenario of EV adoption slowdown driven by consumer hesitancy, charging infrastructure gaps, or economic weakness, traditional automakers with strong internal combustion businesses may outperform. Battery metal prices come under pressure. Oil demand revisions could be upward. The honest assessment is that both scenarios have significant probability. The transition is real, but the timing and pace are genuinely uncertain. Positioning with defined risk through CFDs, using stop losses, and with clear awareness of the binary nature of some of these outcomes is the disciplined approach. BYD's 20% sales growth in Brazil in April 2026 is a data point in a much larger story. The global EV transition is reshaping the auto industry, the commodities market, and the long-term demand trajectory for oil. For traders and investors, the EV theme is not a single trade. It's a multi-layered set of positions across automakers, battery metals, oil, and energy infrastructure. And understanding the interconnections between those layers is what separates reactive trading from genuine market insight. Which part of the EV transition are you watching most closely? Drop it in the comments below. We want to see it. We read everything, guys. We're going to see you in the next video.